when a truck is going, like traveling on a road or being utilized in our country right now, roughly, if you look at it, it travels about 300 kilometers per day. Because of its speed, because of the condition of
You
roads.
see them when you're on the highway, you just see the truck slowly.
Yeah, so it's annoying to overtake and all of that. So yeah, that results in 300 kilometers per day. However, in the US or globally, that averages between 500 and 800 kilometers.
So that's essentially down to, I'm assuming, two things, right? One, the quality of the vehicle, and second, the quality of the roads or the infrastructure.
Yeah.
Right? I mean, it's probably going to be down to these two things. Hello and welcome to another episode of Taking Stock, a weekly podcast where every week we pick one company, one stock, and we deep dive into it. Today we're going to be talking about India's logistics industry, and one of the biggest players in that sector is Delhivery. Right now, let's get right into it again, as we always do. The first thing that I have in front of me is 19,500 crores is the value of the goods moved by Delhivery, one of India's largest e-commerce delivery companies. Now, firstly, what does this number mean? And second, what is its relevance?
So this is the number or the value of the goods moved in one single month in September 2025. So it's a large number. Like, obviously it sounds large, but you have no context of how large it is. So just to put it into context, now there are very varied numbers in terms of what the industry size is.
So essentially, if you're saying that if I order something on Amazon worth 5,000 rupees, that adds 5,000 rupees to this number. Yeah. And if Delhivery is obviously delivered it, that adds 5,000. So the total value of the goods delivered, are they opening and checking? Don't answer that.
So roughly, let's call it 20,000 crores for now.
Fair enough.
Round it up, 500 crores of a roundup. But anyway, so just for context, the total size of the e-commerce market in India is estimated at $200 billion.
$200 billion?
200 billion.
Okay.
Yeah. And now out of that, if you just have to simply divide that by 12, it comes to about $17 billion a month.
Correct.
Those are the sales that Indian e-commerce is clocking.
Right.
Now, out of that, what typically happens is that a majority of it, about 55% of it, is executed in-house. So, for example, if you're placing an order on Amazon, it will be Amazon managing the logistics as well.
Correct.
45% of it is given to third-party logistics players like Delhivery.
Fair enough. So that's about 8 billion.
Yeah, so about $7.5-8 billion. Wow, quick math.
Yeah, mental math.
So about $8 billion that goes to third-party logistics players. Now, if you look at the 20,000 crore number, it roughly turns out to be about 30% of that, of whatever goes to third-party logistics players. Now, while these numbers are based on estimates,
correct.
Another estimate.
Essentially, what you're essentially implying here is that Delhivery is sort of behind 1/3 of the e-commerce deliveries that happen in India through a third-party partner.
It's roughly a quarter of it, between 20 and 25%.
Okay.
That's the better estimate. This is just to give you context and flow it down.
Fair enough.
Based on estimates. So that's an inaccurate estimation. But yeah, roughly about 20-25% of all third-party logistics delivery is done by Delhivery.
Right.
So that's a huge number. So clearly the single largest player in India when it comes to delivery. You've got, if you look at the overall logistics market, you've got several players, right? You've got Blue Dot, Mahindra, CCI, which is, Concor.
Right.
Then you've got DHL, All Cargo, Aegis. But if you look at e-commerce specifically, you've got Delhivery at the top of the chart.
Right.
Then there is Ecom Express, Blue Dart, Express Bees, Shadow Fox.
Right.
Stuff like that comes after.
Correct. So here it says that when this sort of number was released out to the public, the 19,500 crore number for September 2025, the stock suddenly surged by about 4% in a day. So that means obviously this number is extremely relevant and holds symbolic value to the industry and what Delhivery has done in the industry, right?
Yeah, clearly. And one of the things that added to this number looking a little more meaty than it is was the fact that they recently acquired Ecom Express.
Correct.
which was also one of the top 5 players when it comes to
Right.
e-commerce delivery, further strengthening or consolidating its position in the market, and becoming a number one by a larger lead compared to previously. So that
Understood.
number reflecting in the value of goods that they've transported clearly was like a good signal for the market.
Right. Now, I mean, this number is a very recent number, right? It's literally last month or September 2025, last month from the day we are recording.
Yeah.
But 4 years ago, delivery was actually losing a lot of money, right? So probably let's dive into how did they really turn this around? What's changed over the last 4 years? And what are the economics of the business overall?
Yeah, so 4 years ago they were doing a loss of about 490 crores at
A year.
EBITDA level. Yeah,
Right.
now they're doing in FY25 they did a profit of about 370 crore.
Okay.
So it's a very beautiful turnaround.
Right.
And while we're talking about 4 years ago, if I have to go a little slightly more behind to FY19, they were roughly doing about 1600 crores of losses at that point.
Wow.
So from 1600 to 490 to now a profit of nearly 400.
So we're essentially, correct me if I'm wrong, but I'm sort of pegging this down to the fact that also in 2020, when the pandemic hit us, online deliveries, e-commerce industry as a whole sort of surged. And I'm assuming that is one of the major reasons of this turnaround.
Not really. So FY21, if I look at that number as well, they were still doing a loss of about 400 crores.
Right.
They were doing a negative EBITDA margin of roughly 13%. So it wasn't associated with a sudden spike in delivery.
Right.
I think it was COVID brought about a more structural change in the market. And if I look at FY21 to now, their revenue has gone up somewhat around 2.4 times.
Okay.
FY21 to FY25. In
Right.
that 4-year
Right.
period, they've seen a 2.4x jump in revenue. So it's that structural jump and change which has resulted in scale, which has resulted in profitability coming in. So for the logistics business, an important thing to understand is that the single largest driver of profitability is going to be the scale.
Okay.
Because logistics, if you're setting up meaningfully in a country like India, which is so large,
Right.
you're going to have to set up a lot of infrastructure, including warehouses, hubs, sorting,
Correct.
local hubs, national
Right.
hubs, a lot of
Right,
networking to be
right.
done. In that process, and that is a very capital intensive business.
Absolutely.
Right? Or you do tie-ups and put it up on lease or whatever. Irrespective, there is a large infrastructure need. And to set it up, it's going to take a lot of capital. And it's going to also operate in a manner where once the scale comes in, there's a high degree of operating leverage.
Right.
So once you see that operating leverage kick in, will you also see profitability and margins go up?
Correct.
So that is the single largest factor. Obviously, there are multiple other factors,
Absolutely.
but this is the single largest.
So how does, if you sort of had to break down the economics of delivery, right, as a business, I understand that there's multiple factors that have sort of orchestrated this turnaround and got them into a positive number, right, in FY25. But how did they go about achieving these economies of scale?
Yeah. So I think we have to sort of first take a step back and understand what the value chain totally looks like.
Fair enough.
Right. So while we know or have established that, or at least the general perception in public, because that's the part they see,
Right.
is that delivery is a last mile delivery company.
Correct.
Because you see your e-commerce shipments, they'll send you a link for delivery.
Yeah.
You'll probably download the app of delivery.
Or the guy who comes to your house has a delivery cap on or something like that, right? Yeah.
So because of that, you've seen that part. However, in any supply chain, that's just 1/3 of the entire ecosystem.
Right.
So, and 1/3 I'm saying because roughly the supply chain can be divided into 3 parts.
Okay.
One is a first mile.
Right.
First mile is something where you're collecting from the manufacturer or the seller.
Right.
And then you're transporting it to a fulfillment center or a warehouse.
Right.
And then you're storing it there. Right. And then you're doing some initial sorting basis where it is to be delivered, when it is to be delivered, stuff like that. So that is a first mile.
Right.
Now, of the total cost of delivery from the beginning all the way till the end, the first mile makes for about 15 to 20% of the total cost.
Okay. All right.
Then comes the middle mile.
Right.
Now, the middle mile is where you're transporting it between warehouses.
So from a bigger hub to a more localized or to more hyper local hub.
Anyway, so there are a couple of models there. It can either be a hub and spoke model or it can be a network mesh.
Okay.
Or a mesh network. Sorry.
What does that mean?
So hub and spoke is basically that if I have to transport from Mumbai to, let's take an example of Mumbai to Nasik.
Okay.
And Indore is my central hub. Right. So it will go from Mumbai to Indore, which is a hub as well.
Right.
And then it will go from Indore to Nasik, which is a spoke.
Correct.
In a mesh, what will happen is that Mumbai will have a main center. Nasik will also, if it's a big enough center, will have a main center. And it will go directly from Mumbai to Nasik.
Understood.
So it can be both ways, depends on the nature of deliveries, depends on the company's operation.
Right.
There are a lot of factors.
Right. Fair enough.
But any transportation between the manufacturer location and the seller's location, which is between warehouses, adding another hub or whatever that is, right? Transportation and movement on a regional level is known as the middle layer.
Second,
the middle mile.
Right.
And the last mile is when you're picking it up from the local hub and then transporting
delivering it to the
final consumer. And also managing returns and
cancellations and all of that. Yeah.
So you order your 10 items, try it out, send it back. So the first mile is 15 to 20% of the total cost. Middle mile is 25 to 30% of the total cost. And the last mile is about 50 to 55% of the total cost.
Fair enough. So now, in case of delivery, they sort of own the entire chain, or is some of it outsourced, or how does this work for them?
So for any last mile delivery player, it's always going to be beneficial, and in any business, it's always going to be beneficial from a profitability standpoint and a control of business standpoint and quality that you're delivering. To be able to backward integrate.
Correct.
Right? You hear that in chemicals, you hear that in manufacturing, absolutely anything. The aim usually is to say that I will invest in backward integration. These guys also do backward integration. So while, just to give you a background of delivery, they started as a last mile delivery company back in 2011 or 12. They would have gotten into the middle parts, or what you call part truckload and full truckload.
Right.
I'll come to what they are. But they would have gotten into that somewhere around 2021.
Okay.
2016. So a good 5 years later.
Right.
So now what essentially happens is that the last mile delivery, comes on a scooter, cycle.
Correct.
Or if it's a bigger order, it will come in a tempo.
Right.
Your first and middle mile can be transported, is usually transported through trucks.
Because bigger trucks.
Volume is large.
Correct.
Now there are two models here. One is a part truckload PTL, and there's a full truckload FTL.
So let me guess what that means. Right? I honestly have no idea what this means. A part truckload is where 3 different companies are sharing the space, the real estate one truck provides. Is it correct?
No.
Okay. What is it then?
A full truckload is where a single customer's goods are in one single truck.
Okay.
You looked at it from the delivery
guy,
standpoint. It is from the seller's standpoint.
Right.
So look at it this way. Most of your logistics when it comes to industrial goods, if you're transporting 15 fridges from the factory to a warehouse, it will be a FTL transport. Part truckloads will be where e-commerce logistics are more accustomed because they're smaller orders, many more sellers, so they accumulate it and then go through PTL. So if I have to interestingly look at the entire logistics market in India, not just e-commerce, the logistics market, 90% of it is FTL.
Okay.
And then it is equally or more or less equally divided between PTL and last mile delivery.
Right.
But since we are looking only at e-commerce because of delivery, what usually would happen is that these guys have also started PTL and FTL now and have backward integrated. So right from picking it up from the customer's end, all the way to delivering it is somewhat is what this guy does.
So this is all happened in the last 4 to 6 years, is what you're saying, from FY19 to FY25.
No. So company started in 2011 with last mile delivery. 2016 is when they started PTL. Then they launched many more services. We don't need to get into that. FY21 is when they acquired a company called Spot On.
Okay.
Spot On is an established PTL company which they
Right.
acquired just to gain more presence and make
Fair
it
enough.
beefy.
Right.
In 2025, they've acquired Ecom Express to further consolidate the last mile delivery.
Right.
So it is recent developments when it comes to not doubling, but materially increasing their market share. However, the transition has been on since forever.
Correct.
So at this point in time, if I have to look at Delhivery's overall revenue, 60% of it will come from express parcels,
Right.
which is your last mile. About 20% will come from PTL,
Okay.
which is part truckload.
Right.
So that's the ratio you currently have.
Understood.
So about 1/3 is coming from PTL. If I only have to include the miles
Right.
of delivery,
Right.
and 2/3 is coming from express parcel. So one driver for profit margins was scale going up, which has obviously increased. As you can see, the revenue has gone up 2.4x in the last 4 years. Second has been how they've been able to backward integrate and make that more meaningful rather than it just being broken or whatever.
Right.
The third aspect is technology. So if you, imagine this larger player moving
Right.
so many goods with so many shipments on a per day basis. These guys obviously need to be good at tech.
So you're saying everything from tracking to ensuring right orders are delivered to the right place, or in all those scenarios, or also managing the massive workforce that they would have.
No, so I think everything. So
Right.
basically, right from, for example, one is that the customer gets an app. That's one. The manufacturer also needs to track it.
Right.
In the middle, you can't have, for example, if the shipment is left from Nasik and is going to Bombay, there's no guy saying shipment nikal gaya hai, Bombay
पहुंच रहा है, 5 मिनट में.
Then Bombay, there'll be no guy saying truck wale ko bhai kidhar hai.
correct.
That is not happening.
Right.
So there is a lot of tech that is going there.
Correct.
When it comes to sorting,
Right.
the kind of labels you're printing, how you're sorting according to pin codes, how
Right.
the route is decided.
Correct.
The most optimum route when it
Right.
comes to delivering from one place to another. All of that requires tech.
Right.
Even sorting, for example, there is a lot of these sort centers that they have that are completely automated.
Okay.
That don't have manual intervention. And if you look at, I don't know if these guys do it, but if you look at a lot of the international players, you look at these documentaries on various media, you'll see that sorting also for an Amazon and stuff, when they have these large warehouses,
Right.
the placement of goods, putting like the forklift.
Correct.
A small forklift goes there, picks up the right shipment,
Right.
takes it off. It's all robotics and driven by
Right,
automation.
right.
So the more you implement technology and the more you reduce human intervention, it's gonna not only reduce your cost, but also your efficiency.
Correct.
And the faster you're moving goods, the more your churn is and the more money you're making.
Right.
So the more your infrastructure is efficiently used, the better your profitability will be. And not just from a margin standpoint. I'm talking about from an overall margin and investment standpoint. So I'm investing 100 rupees. What is the return I'm making on that?
Correct.
I'll be able to make it faster if I'm automating more efficiently, doing
Correct.
it, using my equipment much more.
Right. So you mentioned Amazon, right? Or you mentioned international global players, right? Now, what I would assume is that the Indian e-commerce industry
Yeah.
would be much, if you just take the US as an example, right? Or even China for an example. The Indian e-commerce industry, let's just look at it as every minute, how many parcels are being sent out. Right? And if you would compare that to another country, let's say a US or a China or somebody with a similar size as India, we would still be much, much lower. Is that a fair assumption?
So e-commerce markets globally are much larger compared to India.
Right.
In terms of value. And that is a function of pricing being more.
Okay.
If you're buying a mason jar here
Right.
versus you're buying a mason jar in the US, there's
Correct.
going to be a big difference in terms of
No internet.
there's going to be a big difference in terms of how much it costs.
Fair enough.
So automatically your value goes up.
Okay. So that 19,500 rupee number that we discussed at the beginning, that number is much, much higher
Yeah.
Outside India, for example. Right?
Yeah.
But in terms of the number and the volumes, that's probably not the case.
Volume would not be materially different.
Okay.
If you look at the frequency of ordering in India, it would be lower. the penetration would be lower, but we have the advantage of a higher population.
Correct.
So put together, we may be doing equivalent volumes compared to US, Europe
Right.
as geographies.
Correct.
However, the pricing is materially different. So just to give you a sense of how materially different, and that is because cheaper labor, cheaper fuel, and more competition in India.
Correct. And also the I'm assuming, right, if you're ordering, and again I'm giving you a very, very basic end consumer example here, but if you're ordering something worth 500 rupees, you're not going to want to pay a shipping charge of 400 rupees on that.
I mean, you'd want it free ideally, right? I mean, that's the mindset
correct,
right now.
Correct, right? And on the other hand, if you are ordering something worth 50,000, a shipping charge of 500 rupees will probably not matter that much.
Possibly.
Right. It's so I'm assuming that's because in India the number of, even though the volume is the same, the value of the order is much lower.
Yeah, the average
which
order
means
value
the
is
pricing and the shipping charges have to be also lower.
Yeah.
Right.
That's one side of it. The other, not side, one part of it. The other part also is that India is still in that phase where we are offering a lot of freebies. We're saying that free delivery, companies are bleeding.
Correct.
Or not making profits, and they're okay doing that because
Right.
the industry is so fast growing and penetration is still lower. So you're also, from a market standpoint, in a nascent stage when it comes to pricing. Like all the quick commerce companies, not quick commerce, but food delivery, Zomato, Swiggy were all free earlier, right?
Yeah, now it's
you're paying slowly, platform fee, this fee, that fee, handling
And I think
charges.
I mean, I'm assuming the strategy here, which would be the same for everybody, is you start really slow and you increase it very incrementally where it doesn't really hit anybody's P&L.
Yeah. So if you compare the pricing of India versus US and Europe, you realize that so India basically right now per delivery makes about, or it costs about 0.36 to 0.36 cents
Okay.
to $1.2
Okay.
roughly. Yeah. US $9.
All right.
And Europe is between $8 and $12. So you're literally at maybe 1/10 when it comes to pricing
Right.
for delivery. So hence, if you try to take a global context and say how much Amazon makes in revenue, plainly out of logistics, it's about $150 billion.
Okay.
Okay. There is DHL, which makes about $34 billion. There's some other company, I can't even pronounce the name here. Kine Nagel.
Okay.
I looked up the pronunciation. Kine Nagel makes about 30 billion. DSV 23 billion. Delivery last year made revenues of about 8,900 crore, which translates to about $1 to $1.2 billion.
So, which is literally 1%, or maybe in some cases lower also.
Yeah. So essentially, we're doing similar volumes,
right?
But our pricing is much lower.
So is this what is the reason behind that? I mean, is this because India is a newer market and e-commerce is sort of still in its early stages in India?
Yeah. So pricing is lower because labor is cheaper. All your delivery boys, your truck drivers, etc., they come at much cheaper pricing compared to the developed countries.
Right.
Second would be your. He tried to not distract us. Sorry.
I mean, good attempt. He just told us 2 minutes more because the camera is going to stop.
Okay. So labor is cheaper, fuel is cheaper. Competition is higher, so people are undercutting each other and trying to keep pricing minimal.
Right.
And industry is nascent. So all these four factors come to a point where India's pricing is lower. However, you also have to flip the coin and look at the other side. And the other side is that there is a lot of leeway that India has when it comes to increasing pricing from here. So on the other hand, the single largest advantage that India has when it comes to the entire ecosystem is that there is a lot of opportunity from here. And because we are at such a nascent stage, there is tremendous ground to cover over the coming years. And I would probably break that down into a few parts. One is sheer size of the market, because we still it's not fair that India is doing an equal number of shipments as US, for example, because our population is so much
So much higher. And I think the adoption is still quite limited to tier 1, tier 2 cities, right? And it's
Yeah.
still not gone to the deeper pockets of the country.
Yeah. So one driver of growth is the overall consumption of e-commerce itself increasing.
Right.
And then you've got those multiple typical factors: unorganized to organized, richer people, blah blah. I don't get into those. Those are the most generic things you can talk about.
Correct. For every industry, yeah.
Yeah. So those can be avoided. The second factor is the rise of D2C and SMEs. So D2C brands, social commerce, omni-channel have all been sub-drivers within the e-commerce space.
Right.
So it's not only the larger brands now, a lot of like smaller homegrown brands have been coming
Correct.
up. That drives a lot more growth and explosion in the industry. And that's on the revenue front, right? When it comes to the operational front, a couple of very interesting facts that we have about the logistics industry in India compared to the globe are that our truck utilization is very poor.
What does that mean?
So, for example, when a truck is going, like traveling on a road or being utilized in our country right now, roughly, if you look at it, it travels about 300 kilometers per day. Because of its speed, because of the condition of
We
roads.
see them when you're on the highway, you just see the truck slowly.
Yeah, so it's annoying to like overtake and all of that. So yeah, that results in 300 kilometers per day. However, in the US or globally, that average is between 500 and 800 kilometers.
So that's essentially down to, I'm assuming, two things, right? One, the quality of the vehicle, and second, the quality of the roads or the infrastructure.
Yeah.
Right? I mean, it's probably going to be down to these two
Yeah.
things.
And second is that 40% of these trucks are running empty. So the utilization is also low there because the infrastructure development is there, competition is there, but demand sort of is still catching up and
Right.
stuff like that. So on both these factors, if you see improvement over the next few years, you will come to a point where profitability has to shoot up because industry is growing, and as we've established, scale is necessary for profitability in such a business.
Right.
Second, your efficiency is improving. And thirdly, because you're fully integrated, you're able to take advantage of that integration and further leverage it.
Right.
So that's where we're at.
So, I mean, all of this, I think it's quite established, right? That, and I don't think there will be anybody who can argue against the fact that this is an industry that's only going to keep growing.
Yeah.
The demand's only going to keep increasing. But in terms of sort of, let's say, numbers and profitability, how do you think this would actually translate?
So essentially, if you have to look at the last 5 years, including acquisitions, specifically Delhivery, has done say from FY19 to FY25, let's put that as the year.
Right.
They've done a 32% CAGR in revenue growth.
Right.
Actually, let's look at FY21 and 25. That's an interesting period because if I have to look at their warehousing infra, that has gone up by 1.6x.
Right.
The revenue has gone up by 2.4x.
Right.
Essentially, what I'm talking about leverage is also showing up in this, where a particular investment in infra can lead to a slightly higher
return in revenue.
in terms of revenue. Now, this has to, while we're doing the financial projections and stuff like that, we have to translate this into our numbers.
Right.
So if I have to go about thinking about what the company will do in terms of financials over the next few years, one simple fact is that while growth potential is there, and while we've been saying that the industry is nascent and stuff like that, you can't have an industry like this of this size continue growing at 30% every year.
Correct.
It will normalize. Right. So in the next few years, you can assume that it will grow at say 14, 15, mid-teens kind of growth. In that, you can then make assumptions whether delivery will be higher growth, lower growth. Maybe they'll increase market share or keep it constant.
Right.
So that is the growth assumption I would typically hint towards or drive myself towards. When it comes to profitability, now they've come from 13.6% negative margin in FY21 to 4.2% positive margin.
Right.
Now, if I have to look at all the three factors that we mentioned, scale, backward integration, tech, and efficiency, 4 factors.
Right.
And additionally, actually 5, because they're also doing a lot more additional services like supply chain consulting, providing tech solutions, doing customs broking, doing freight abroad, doing FTL. So a lot of new stuff is coming up.
Correct.
So, and that is all high margin stuff.
Right.
So if I have to look at those factors in isolation of Delhivery's position and specific to Delhivery's position, two factors. Number one, that e-commerce logistics will see higher scale because of the consolidation of Ecom Express.
Right.
So that gives them a better pricing power, more market share, higher negotiation ability. So that margin will improve. Secondly, in PTL, since they acquired Spot On, and now that has stabilized, that is still that is a faster growing business and a more profitable business.
Understood.
And if PTL grows faster than your end mile, it will add to the overall margin.
Correct.
Right? Now, just one more thing on this is that PTL is a higher profitability business inherently.
Right.
That's because when you're transporting bulk from one warehouse to another warehouse, there is predictability. You know timings.
Right.
There is no returns.
Yeah.
You know what is happening.
And you sort of control the entire start to end system. Yeah.
Including utilization. That warehouse is never going to send somebody back. Right.
Correct.
It's not going to happen.
Correct.
So PTL is a lovely business to be in compared to last mile. If that is going to grow higher, again, you'll see margin expansion. So all of these factors would ideally make me believe that from 4.2%, margins can go up tremendously from here over the coming years.
Right.
So that is the second assumption to put in. And this is on the income statement. Now, the other thing to note is that this business, as we've stated, is capital intensive, but the capex intensity is very high in the beginning.
Which they've already sort of incurred. Yeah.
Because to achieve scale and to be a player taken seriously by anybody, you need pan-India presence.
Right.
To build a pan-India presence, you need to invest.
Correct.
If you're investing without a established presence, you have to incur losses.
Right.
These guys have been doing it since 2011 or 12.
Right.
So they've gone through their 15 years of struggling with these factors and have finally come to this place. So from here, the capex intensity will stabilize.
Correct.
Would be my guess. So if I have to project capital requirement from here on, I would peg it at, looking at recent financials, somewhere between 5 to 7% of revenue.
Okay.
So essentially 5 to 7% of revenue I will have to put in the business, but I will still be able to achieve mid-teens growth.
Understood.
Because every infrastructure I'm putting in can get me a little bit of a multiplier when it comes to revenue.
Right, absolutely.
So all this I will scramble into my model, basically,
correct.
when it comes to financial projections.
Right.
So essentially what we're looking at is mid-teen growth on revenue, margin expansion, and hence much higher PAT growth and EBITDA and PAT growth.
Fair enough. Absolutely makes sense. Now, also, I mean, one thing that we always sort of end every podcast with is the valuation, right? And I've always had this question, right? That, when a company is, there are a lot of companies that are listed but are still in their loss-making phase, just like how Delhivery was about 4 years ago, right? So how do you firstly go about valuing a loss-making company?
So arbitrary methods.
Okay.
So because it's loss making, there's nothing to peg it on. Usually, right? Because it's loss making, you can't say.
So it's obviously based on future potential.
Yeah.
Right. So, to simplify it.
To simplify it, yes. But the difficult part in such a situation is that sometimes these companies don't have visibility of profitability for multiple years going forward.
Correct.
So if you look at like a lot of our discussions previously, we are always looking at 2 years forward, 1 year forward, 3 years forward. In such cases, this has turned profitable.
This has turned profitable now.
But imagine valuing this company in 2015 and it's turned profitable in 2024 or 2025.
Right.
You've got 10 years of losses. How do you even value it?
Right.
So typically you would use something known as a DCF, which is a discounted cash flow method.
Okay.
A common method used for startups, for companies with low profitability. And I would also use it for a company like Delhivery, despite it being profitable.
Okay.
Because it's just turned profitable. And it's operating at a 4% margin. Now I know from the fundamentals that we spoke about that 4% is not its ideal margin. It is still on the lower side and it's just in the nascent stage of profitability. So even if I have to project 2-3 years, I don't think it will reach normal state of margins at that time. So I wouldn't value it on that metric and get a lower, get a sense of valuations being a lower level because my profitability is lower and whatever multiple I give will return a lower number to me.
Right.
So typically I would do a DCF on this. Assumptions we've already spoken about. If I did a rough DCF on this. value comes to a certain amount, we can't. Roughly, it came to, let's say, about 35-40,000 crores. It can come to, depending on your numbers,
Okay.
which is purely an individual exercise to conduct.
Right.
DCFs are very, very sensitive to the measures or inputs you put in.
Right.
So even a 0.1% up or down can materially change it. So don't take my number seriously at all. This is
Fair
just a
enough.
placeholder for this conversation. No view at all. Lot of disclaimers. Don't want to get into trouble. No view, no opinion. Okay. So if I have to assume that my DCF led to a 35,000 crore market cap valuation,
Right.
that is an upside from here. That's one. Secondly, will I rely completely on it? Not really. What I would then look at is, if I'm looking at a 35,000 crore market cap, what does it mean in terms of an implied EV EBITDA today? Okay. So if I have to take out the implied EV EBITDA, that would give me a better sense of how much it is valued at. So there are two ways of going about it. Either I project FY28 EBITDA for Delhivery. If I take Motilal Oswal's assumptions from their report, it comes to about 41 times FY28 EV EBITDA.
Okay.
Right? However, if I have to use the DCF and say valuation comes to 35,000 crores, it implies an EV EBITDA of 36 times. Now, this is what I'm talking about. If it were 41 times,
Right.
so my EBITDA is lower. But if I take a slightly longer period, which is 10 years, and then take a
Correct.
terminal
Then
value,
it increases. Yeah.
then I get a more rationalized sense of the valuation. So my EV EBITDA on an implied level comes to a more reasonable number compared to projecting 2 years ahead and then giving it a valuation.
Makes sense. Makes
So
sense.
I would typically do that. But just to compare it and make it simpler, because this discussion became a little heavy.
Yeah.
To make it simpler, going by again the broker's numbers, if my EV EBITDA on a 2-year forward basis is 41 times for Delhivery, Blue Dart is at an 18 times, VRL Logistics at 10 times, Mahindra Logistics at 7 times, and TCI Express at about 7 times. So Delhivery is trading at anywhere between a 3 to 4 times premium to all of these players.
To them, yeah.
Now, what would justify such a premium? If their growth is 3 to 4 times higher,
The potential increase in market share.
market share being the highest,
Right.
because scale determines it.
Right.
Profitability, return ratios. If they are scoring better than the peers at all of these, then the
Premium is
would
justified. Right.
Additionally, and these are quantitative factors.
Right.
Qualitatively, I would look at where delivery is present versus where, for example, a VRL Logistics is present. VRL, for example, is a more FTL, PTL player and more into fleet management and
Right.
The trucks part. of it.
Correct.
Not in the e-commerce part, which is the sexy, high growth
Right.
industry.
Correct.
So I would then again give it a premium, Delhivery a premium on top of that for this as well.
Right.
So all these factors then I would sort of put into place and figure whether do I want to pay 3x, 4x on such a company.
Right. So it also, I mean, this is quite a fascinating number, right? Where it says the last 1 year stock return between Delhivery, Blue Dart, VRL, Mahindra, and FedEx, right? And out of all of these 5 companies, Delhivery is the only one that has given a positive stock return.
See, that's the thing, despite it being at such a premium valuation,
Right.
you would imagine that valuations are so steep.
Correct.
Maybe the delta should be lesser. But maybe when growth is high and the market is receptive towards growth and the return ratios are good, the market is okay. I've seen this in the industry where as long as growth is there, your valuation premium will sustain.
Right.
The moment growth tapers off, your valuation premium will taper off.
Understood.
So, and I'm talking about relative growth. So relative growth, if X is doing 10 and this guy is doing 30, that delta should continue.
Correct.
If the other one does 2, this one can do 6 and that delta is still there.
Understood.
And the other couple of points which I missed on valuations is that number one, clean balance sheet. There's barely any debt. Very strong cash flows. They're making a free cash flow of about 7 to 9% of their revenue, which is very, very healthy. So look at it this way. CapEx requirements are 5 to 6% of revenue. And they're making a free cash flow of 7 to 9% of revenue. So essentially they're making more cash than the business requires in terms of investment.
Correct.
Good place to be in.
Right. Okay, so let's get into the community question for this week. Now, to give everybody context, community question is every week we pick a question from our social platforms, either from the DMs, comments, wherever, and we pick one question and we get Sagar to answer that question. So this week, Sagar, we've got Rohan from Chennai, who's asked, I recently watched your video where you talk about diversifying your portfolio and how giving one stock too much weightage is counterproductive. What is the ideal weightage you'd give one stock?
Wow. So
I think the little context about the video that we're talking about is I think you were sort of dissecting one portfolio where I think there were 55 stocks and one out of those 55 stocks had a weightage of about 75%.
Yeah.
So obviously that is quite counterproductive, but what would be your answer to this question?
So there's a very theoretical and mathematical approach to it, which is a base level. We don't really follow that rudimentary an approach.
Right.
But if I have to explain it and put it very simply, we recommend that having anywhere between 15 and 20 stocks is optimum for a portfolio.
Okay.
From a mathematical standpoint, beyond 17 is counterproductive.
Okay.
So the amount of risk reduction you would achieve would be lesser than the amount of return dilution you would face with each incremental addition beyond 17 stocks.
Fair enough.
So let's take 20 as a good number of stocks to have in a portfolio.
Right.
That would translate roughly to 5%
Per stock,
equal weighted. But an equal weighted portfolio is not something that is ideal.
Right.
So one level above that, if you have to think about it, this was level 1. Level 2 thinking is that how much conviction do I have on what stock?
Right.
And I would place the amount of weight to be proportional to the amount of conviction if I have.
Okay.
So for example, I am really betting big on Delhivery, for example, if that is the stock I'm going gung-ho on.
Right.
I would maybe increase it to 7.5%, 10%, 15%, 20%.
Depending on how strong your conviction is.
Yeah, depending on how confident I am, how much I know about the company, how much I understand, stuff like that.
Right.
That's one way of looking at it. Now, level 3 is more technical, and from an analyst or portfolio manager's perspective, is to say that let's look at what the expected return of a certain stock is, and what is the volatility or standard deviation that is expected from that stock.
Okay.
Now, I would make my weightage directly proportional to the amount of expected returns divided by the expected volatility.
Okay.
So higher the reward for the amount of risk I'm taking, the higher will be the weight.
Fair enough.
So I would make it that way. Level 4 is to figure out which sectors I'm positive on. What am I positive on in terms of large cap, mid cap, small cap? Am I at my fund level taking a strategy that is more value oriented or growth oriented? Am I playing high beta or low beta? Stuff like that.
Right.
And then deciding or taking all these factors into consideration and then deciding on the weight.
Fair
but
enough.
That's a scale of purely basic to purely advanced.
Correct.
You can choose where you are, and
So I've got another extension to this question, right? When you say the perfect or the ideal portfolio is 15 to 20 stocks, right? When somebody invests in a mutual fund has more than 20 stocks. So what happens there?
you're putting me in a spot.
All your fund managers are going to come running behind you.
No,
No?
also, we recommend mutual funds as part of the wealth
Right.
arm, right? But see, ideally, I'll stick to the same answer. It's not advisable from a portfolio standpoint to have more than 20 stocks.
Right.
So my portfolio, for example, my personal portfolio does not have more than 20.
Right.
But that is because I am a professional. I don't invest in mutual funds. I like to take control of what I'm doing.
Correct.
And I have my own choice.
Right.
And I understand it. I do that for a living.
Right.
So I can afford to do that. But again, 20 is ideal. Beyond that, and what people end up with is multiple schemes. Each scheme will have 50 to 60 stocks.
Correct.
They'll end up with probably 100, 200 or more stocks.
Right.
Instead of that, you're better off, and you're paying 1.5%, 2% management fee on that portfolio. If you're going to hold 500 stocks at the end of the day, you might as well buy a Nifty 500 ETF, pay a 0.3% management fee and get done with it.
Right.
Why even bother? So, I mean, if you're going that route, then the easier way to do is this. But
Fair
at
enough.
the cost of cannibalizing our own business, I am giving the right answer.
Fair enough. Honesty is the best policy.
Yeah.
Okay, great. Hope that answers the question, Rohan. And thank you so much, everybody, for tuning in. Hope to see you guys again. We launch new episodes. We go live with our new episodes every Tuesday, and every week we pick one stock, one company, and deep dive into it. Thank you so much again for listening.
Disclaimer. This content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.